And thank all of you very much. Lisa, when I was listening to Lisa's presentation, great presentation on penny hoarding, that's what Wall Street is these days, by the way, as far as traders. The traders are not you guys or me, it's computers. I'm not demonizing them, I'm just saying that they trade for fractions of a penny billions of times a day. And truly billions of times a day. When I started in this business, which was 1981, I had just finished playing football for the Bears for 4 games. Not seasons, 4 games. So I know about decaying assets. That made me an expert on that. And Mike Singletary now has a bust in the Hall of Fame instead of me because I was a linebacker. And my mom says, yeah, that should have been you. But luckily, I'm here instead of there. And I think the volumes that we traded back then, folks, was 49 million shares, I believe, an average trading day on the New York Stock Exchange. We virtually trade that in about 3.5, 4 minutes on the New York Stock Exchange when it opens now, to give you an idea of how fast and how much bigger the market is now. I don't compete with those high-frequency traders, and again, to Lisa's penny hoarding, the biggest firms in that space make billions of dollars a month from jumping in front, in and out, almost as fast as the speed of light. Ahead of, you don't even ever see them, you don't see their trades, but we can lean on it and use that liquidity, and that's what I do. So I won't belabor the point. Like I say, it is the market that we have, and it's just very, very deep, very, very liquid. This is an extremely exciting time because of the changes. Whenever there's big change in an industry, like we have now, there used to be 7,000 traders on the floor in Chicago between the Merck, Chicago Board Option Exchange, and the CBOE. Now, there are maybe 500, and most of them are just standing there because it's been mandated that you have to have a certain amount of people on the floor for every server that you have down in the basement of some data center. And basically, that's just a matter of time before they're gone. It's all electronic. But that doesn't mean that there aren't traders. It's just different time frames. And so I'll touch on that a little, and I'll show you a little bit about what we do. For those of you who don't know, my brother and I work on CNBC. We do it because it's fun. We also do it because it helps promote our businesses. As Jordan was nice enough to say, we sold one of those businesses to E-Trade coming up on 3 years ago this fall. We grew it from nothing. It was all open source. We built that in 2008, sold it in 2016, and it was a great ride. Now we do an awful lot on the education side, which is one of the reasons Kim Githler and Jordan and Charlie wanted me to come here and speak to you guys. So I'm privileged to do that. This is what I do when I'm at CNBC. I'm constantly pointing out which stocks we're buying and selling and why. My brother and I were instrumental in pitching Fast Money, a show that became the most popular show on the network. And now we're both on the halftime report, which ever since we switched over, which was basically the Beijing Olympics, we started in 2008 doing a halftime report just during the Olympics because CNBC's coverage was of the Olympics for the afternoon. They found that the ratings went up so much for the halftime report that they started it as a daily offering. And now that's what I do virtually every day. So I talk about unusual activity, which I'll define in just a minute, and then tell you how we jump on with those folks that are making those bets. I'm not going to belabor that one. And by the way, I'm signing books this afternoon. All the books that we have are being given away to anybody who comes. You don't have to pay us a penny. When we run the ads on TV, we have sold, my brother and I, over 240,000 books that we've basically given away. We've written 3 books. This is our 4th book. We give it away, and they just pay shipping and handling. But anybody who gets there, hopefully many of you will get a free book. If you don't, we have cards so that we can send you the book just for filling out the card, and you will not be charged. I love this little guy right here, by the way, the guy holding his head, bald head, just like my bald head. That's Peter Tuchman. Peter's the guy that makes those hats that say Dow 21,000, Dow 22,000. He was having to make them so fast in 2017 through the basically end of 2018 that he couldn't keep up with the demand because we were just smashing through 1,000-point levels of the Dow Jones Industrials. And yet, last year, at the end of last year, if you might recall, we had a pretty big debacle. First debacle was in October after the Fed chairman came out and said, you know, basically we were pretty darn far from neutral, meaning that there might be a lot more interest rate increases, and that's not what the market wanted to hear. And as you've heard me and others say, the market can act just like a spoiled child. When you tell us something we don't want to hear, everybody hits the exits, and it gets ugly really fast. There's an old expression that goes, the market takes the stairs up and the elevator down because we drop so much faster than we rise. October was a great example of that. December was an even better example. And then you have something like Christmas Eve, December 24th, when the Treasury Secretary, Mnuchin, came out over the weekend and said, I talked to all the banks. They tell me everything's fine, don't worry. And everybody's like, who was worried? Why did you have to tell us that? And of course, we fell 600 points in 3 hours, a half day after that. I mean, it was the stupidest comment from a really smart guy that I've heard in an awful long time. Because when Hank Paulson was the Treasury Secretary, another former Goldman Sachs guy that I know fairly well, Secretary Paulson pulled all those bankers in, made Jamie Dimon take money, made the rest of them that needed the money take the money, so that, because he said, Jamie, if you don't take it, the rest of the world will know that you're the only bank that's going to be standing, and you'll only be standing until there's a run on your bank, and then the whole system collapses. You have to take the money, otherwise it looks like, again, that there's a run on all these banks, which there was in 2008. I knew a lot of hedge funds that I deal with that couldn't get their money out of the banks, couldn't get their money out of the brokerage firms during that time frame. I had too much money in the bank, luckily, and I started buying a ton of properties because the market was falling apart, so they were good deals, but also because I couldn't trust the banks. I mean, what are you going to do if you're stuck with a bunch of cash? Nice problem to have, but if you're stuck with a bunch of cash and all of a sudden people are being told they can't take money out, that's a bad thing, a really bad thing, and that's why it was so negative when Secretary Mnuchin said what he said on December 24th. But you've seen how quickly the market responds to Jerome Powell relaxing and saying, well, maybe we are a lot closer to neutral than I expressed October 3rd, and so forth. I won't belabor the point. There's several ways you can pick stocks, as you guys know. One of my favorites is to find a smart monkey and to let him throw darts at the board. Actually, that's not. But when I was on Fox for 10 years, every year they'd bring a monkey on to throw darts at the board to see if he could beat me. And every once in a while, the monkey had a pretty good insight into what stocks were going to do well. But for the most part, the monkey didn't do that well. So I'm going to give you guys a little bit on trading. I know many of you that are students probably haven't had as much access to trading because you've been so busy working in school and trying to pay for all that tuition and all. But when traders look at trading, one of the most popular ways they do it is with technical analysis. I am not an expert on technical analysis. I would be the first to tell you every ship at the bottom of the sea was loaded with charts because it's true. But it's also true that if the people reading those charts would have read them correctly, maybe the ship wouldn't have run aground and sank. So with that said, here's a little bit on technical analysis. There are certain price points technically on a chart where you can say the market seems overbought or oversold. Obviously, overbought would be an example from September when the markets were just going up, leaps and bounds every single day, September of 2018. It was a phenomenal run. And then the crescendo was, again, October 3rd when Jerome Powell, the Fed chairman, said what he said about rates. So the market can near a resistance area, in other words, an area where people say, there's been accumulations up to this level, but we haven't been able to break through it, so now that has become resistance. And I'll show you an example of that. That would be something that once we get up to that level, you have an awful lot of people that start looking at that and saying, I think we need to sell here, or at least lighten up. And the more that they do that, Gesundheit, the more you're going to see people accelerating perhaps the profit taking at that given level. That's an example of resistance. Support is when the market falls to a certain level or a stock falls to a certain level, like Apple, and you might say, boy, you know, this is long-term support. This is support going back 200 days. This is support going back 3 years, whatever it is. And we expect the stock to bounce. We expect smart buyers to come in at that level, for instance. And so I've got a couple examples of that. So S&P 500, this is an example of resistance. As you guys can see here, S&P 500 daily, and this is basically through December all the way to where we are now. And we were banging up against resistance here, 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 and then we failed and sold off so harsh in December. But as I said, there's the run into September, and then when we started coming down, we kept hitting this same resistance point right here, right around that 2830 level for the S&P 500. That's an example of resistance. And so an awful lot of people, it becomes a self-fulfilling prophecy in a way. They start selling when we get up to an area where there is resistance. Here is an example of support. So for instance, after these big run-ups, so here's the run-up 2017 to 2018, beginning of last year, just right around the Super Bowl, we started selling off very hard here, and we fell all the way down to this level, and then rallied all the way back up, again, hit a resistance point perhaps when you look at that top and this top, and then sold all the way down to basically right here, you know, where a lot of us might say that was what the long-term support area was for that particular indice, the Dow Jones. 30 different stocks, obviously, but they're some of the biggest stocks in the world. People do pay attention to what goes on at those levels. My brother and I don't really trade an awful lot on fundamentals or on technical analysis. Instead, we trade a lot based on smart money. And some of you might say, okay, well, why is it smart money? Are you just giving these guys credit, you know, whether it's Mark Lazary or David Tepper, both of whom are good friends and huge traders. One's a distressed asset trader, by the way. That's Mark Lazary. David Tepper's a guy that has just been a fabulous stock picker. He had the good fortune of not becoming a partner at Goldman Sachs, and so he said, screw you, and left and became a multi-billionaire and now owns the Carolina Panthers, and one of the best traders you'd ever meet. Goldman doesn't always make the best decisions, but they are good people. And so every once in a while you miss one, and David was one of them that they missed. So why would I follow smart money like David Tepper? I would follow that smart money because they have millions of dollars in commissions. So when you trade, obviously all of us, unless you guys are trading through Robinhood, and if you are, it's just a different way of collecting a commission on you. I can touch on that in a minute. But if you trade through Morgan Stanley, Goldman Sachs, UBS, Deutsche Bank, Paribas, any of these global investment banks and brokerages, they're charging you something for trading. Why? Because number one, they're holding your money, and they need to make some money on holding your money, and you're using your money. When you use all of your money and go for leverage, whether that's 2-for-1 leverage or whether you have a special deal with the brokerage firm, I used to trade at 200-to-1 leverage. 200-to-1 leverage is pretty big. So if you can imagine, because I was a market maker, we could trade at, like I say, I could put up $1,000 and trade it as if it was $200,000. My brother Pete used to routinely be the biggest trader in AOL, America Online, which none of you even know what it was. But Pete used to be the biggest trader in there, and when it was a $140 stock or whatever it was, he would carry million or $1.5 million shares of that stock. So 1 million shares of a $100 stock is $100 million. That's because my brother Pete is crazy. But he's also one of the most disciplined people you'll ever meet. Not only disciplined in how he eats and how he exercises, but how he watches his money. And I'll touch on that in a couple slides, because that is one of the most important things when you're trading, is being disciplined. But again, back to the smart money, they have, you know, whether it's Tepper, whether it's Carl Icahn, whomever, tens of millions of dollars in commissions that they generate every year. And so they do everything from using some of that money to get a free Bloomberg, if you want to say free. Bloomberg's something that runs you anywhere from $2,800 a month to $5,000 a month or so, depending how much stuff you have on it. It's a great device, and that's why Michael Bloomberg is as rich as he is. Just a brilliant guy and made a fantastic empire for himself. And by the way, bought the rest of it back because he gave Merrill Lynch a 30% investment in it back in when he started it. And then in the 2008 meltdown, the head of Merrill Lynch sold that piece back to Bloomberg on the bottom, which was, again, just a sign of how smart Michael Bloomberg is and how dumb the guy is that was running Merrill Lynch. So these guys have tens of millions of dollars in commissions, and they spend those commissions trading through Cowen, trading through Morgan Stanley, so that they can get free stuff. In many cases, they get free office space, they get their Bloomberg, they get all this analyst research. And so whenever we talk about upgrades from Goldman Sachs or from SunTrust or whomever it might be, they're giving those upgrades to their best clients first. They're not telling you or me all the different upgrades and why they're upgrading it, or I was just at this conference and this guy said something amazing that makes this stock a tremendous buy, or something terribly stupid that means we should get the hell out of this stock. They don't just give that out. They instead exchange that for the commission dollars that these folks spend. And that's one of the reasons you want to follow the smart money. They're getting information you can't afford to. You might be one person sitting at home doing a tremendous job of fundamental analysis, technical analysis, reading everything you can about the company and so forth, and you still have no shot compared to these guys because they're getting stuff that's time critical right now, stuff that's going to move that stock right now. Now, your time frame might be much longer. Time frame might be I'm investing for a year, for 2 years, 3 years, fine. But these guys want to make that quick hit when it makes a 15% pop on that upgrade or when it falls 20% on a downgrade. So that's why we follow the smart money. They also have dozens of eyeballs, all these young smart folks like you that are out there working for the investment banks. They're the ones that are going to those conferences. They're the ones poring over all those spreadsheets and so forth. So you're one person, and if I have 20 people working for me, I've got 40 eyeballs looking at stuff. I can cover a lot more ground than you can. That's another reason we follow the smart money. Again, they attend industry events like first week, or actually second week, but starts the first week of every year, JP Morgan Healthcare Conference. I'm sure once you guys start following healthcare stocks, you'll see those stocks hopping like this into that and then through that event, because people will talk about deals, talk about new products, talk about potential approval or phase 1, phase 2 trials and how they're going. They'll do all those things at ASCO, the American Society for Clinical Oncology, or any of these kinds of things. Those really give them an edge when they can attend that. And they're not free. Either you're doing, again, tens of millions in commissions through them. You can't just show up at the JP Morgan Healthcare Conference and say, yeah, I'm here to attend. No. These events, if you could buy your way in, are $5,000, $6,000. But you get to do $20,000 or more in commissions, welcome to come. So again, another reason that it's more difficult for you and me to have the same edge that the smart money has. They also trade in the blink of an eye. When I talked about that high-frequency trading and things, and I'm not demonizing high-frequency trading. I do think that they should bring back the uptick rule. My brother Pete and Leon Cooperman talk eloquently about that on our program, CNBC, all the time. There used to be a rule after the crash of '29 that basically they said in order to sell a stock, you have to own that stock if it's going down. You can't just continue to pound it into the ground, because what happens, of course, is the fear kicks in and people just say, oh, screw it, and they just sell everything. That's what was happening in '29. So they put an uptick rule, meaning that if the stock last traded at $29, it must uptick from there for you, a short seller, somebody who does not own the stock, to sell it. If it does not uptick, I can say all day, I'm a seller at 29, but they don't even have to display it. because I can't sell it there. Instead, they have to display me at the first uptick from there. So it stops these runs that we saw, for instance, during December. But they have done away with the uptick rule. So now in the blink of an eye, these algorithms, which are very smart, they're not neural networks yet, but they're very close, and many of them do use artificial intelligence. They know, because they're programmed by smart traders that understand that if stocks are trading on the bid, I want you to lower my bid, I want you to increase my offer, and I want you to decrease the number of shares that I'm bidding for. So what is that doing? It's causing that thing to waterfall and roll over. And since the other algorithms know that everybody else's algorithms are doing this, the more it starts going down, the faster it goes down. Because then the other algorithms, you're lowering the amount that you're bidding for and you're lowering the price. The selling just continues to waterfall into that until it hits some crazy level, and then sometimes it bounces. But a lot of times it doesn't. And so that's one of our arguments with high-frequency trading, and one of the only real issues I have with it. Also, they are committing not $1,000 like you guys and I might commit. They're not committing $100,000 or $1 million, because when you're managing $19 billion like David Tepper, you can't trade anything less than 1 million shares of something. It doesn't make any sense, because if you made 100% on it, it's not even going to impact the interest that you're basically earning on the money that you have under management. You've got to make really big bets. And that's one of the things that when we talk about scale, it's so tough for the folks once they graduate to a certain level. A lot of them peter out right at that level where they can't make enough money on the money they've got to justify the size that they are. You know, they can trade $100,000, they can trade $10 million, but they can't put to work $1 billion because they just haven't figured out how to do it, and they can't make a return that's enough to have people leave their money with them. So those are all the reasons we follow smart money. This is one of the reasons that I love options. When I came into the business, I came in on the option side, because when I washed out with the Bears, I went down to the trading floor and I wanted to be a trader. My agent was a trader. He had 3 professional athletes other than me that were down there. Why? Because he said discipline is so important, that you guys already have the discipline. If you can apply it to this, you can make a lot of money. So I went down to the options pits. Back then, we used to trade about 400,000 options a day on the then 4 options exchanges. There was the PECOS, the Chicago Board Option Exchange, the PHLX, and the Amex. Now there are 17 option exchanges, and almost all of them are all electronic. And we trade 18 million options a day. Give you an idea of how that thing hockey sticked and how big derivative trading is now. One of the reasons that I love following the smart money in options are these 3 facts. Time frame. When somebody buys a lot of options, they're telling me a lot of information that I can't get with stock. When they buy a lot of options, they're telling me time frame. How fast do I think this is going to happen? If today is February 7th and they're buying June options, they think it's going to play out over time. This is an older chart, but I'm just saying, in the example here, June, well, obviously that's a full 4 months further out into the future. A lot can happen in 4 months. This is more of an investment. It's not the same thing at all as when they buy options that are expiring tomorrow, or options that expire next Friday, which is February options expiration. The 3rd Friday of each month, unless it happens to be a holiday, is usually when monthly options expire. But many of us know that there are also weekly options that are out there. So it's important because they tell us the time frame. It's also important because they give me a price target. So with the stock trading, for instance, this example's Take-Two Interactive. With Take-Two back in that day trading 24.36, if they're buying the 24 strike, okay, they want a slightly leveraged bet, but they're not exactly putting a lot of money on the line with this particular bet. They're right at the money. They're not saying, I think it's going to leap 10% and these options are going to double. They're saying, I'm going to buy these options for, if you look over here, those options we're trading for, where is that? Market change 5 cents. Where's the price? Well, it looks like I took the price out. Sorry about that. But they're buying these options rather than buying the 28 strike, for instance. I'd be much more bullish if they were buying the 28 than the 24, because maybe they just want something that's going to kind of simulate owning the stock. That's when you buy an in-the-money call option. You want something that's going to move with the stock. It's not going to double, triple, quadruple unless the stock doubles or triples or quadruples. They also tell us leverage. How much leverage do they want? Well, since the stock is $24.36, and if they're paying $2, they're getting 10-to-1 leverage. They could buy the stock outright. 1,000 shares would be $24,000. Or they could buy these and put $2,200, because every option's for 100 shares of stock. So if they're buying these options for $2.22, that's $222 per option. If they buy 10 of them, $2,200, it's simulating a 1,000-share position. That tells me that they want leverage, which is something that I want to follow. This is a friend of mine. I reached out to him because I like his podcast, Jocko Willick. Willick, rather. I always say Nick, but Willick. Former Navy SEAL. He has an interesting podcast on discipline. Sometimes they're kind of tough to get through, but he's built a huge business on talking about leadership and discipline. And as I said moments ago, discipline is one of the most important things for us as traders. I have to be willing to take losses. If I'm not willing to take losses, I'm not going to last. That monkey that I showed you isn't going to know how to take losses. My dad used to tell me, and my dad's still living, he's a lovely guy, 92 years old, transplant surgeon. That's why they call me Dr. J, because for him, I took the moniker DRJ, Dr. J, because he's a transplant surgeon and, you know, fabulous guy. And he would always say that you could teach that monkey to do a kidney transplant, but he said the monkey's not going to know when to do the kidney transplant. So that's one of the most important things in his world, and in my world, discipline is the most important thing, because anybody can throw a dart at a board and get lucky every once in a while with a good stock. But then you got to know, how do you manage that profit, and how do you manage the loss? And that's what I'm going to show you here, because Pete talks about this all the time. Discipline dictates action, DDA. The acronym doesn't have to be important to you, but the most important thing whenever you're making an investment is how much can I lose, not how much can I make. Because a lot of you, and me included, will get excited by the idea of making a home run, hitting a home run, making a windfall on a particular investment. It's not what you should think about. You should think about how much can I lose. That's not to scare you off, but it's just to discipline yourself so that you say, okay, I know I can lose in this investment, but I'm comfortable because I've already considered that. Second point, cut your losses at a predetermined price. For me, whenever I buy an option for $1, I was just out in the hall talking to a guy, and he said, John, what are your returns like? And why don't you put them up on CNBC? And I said, good question. But I said, number one, the SEC and FINRA won't let me because everything has to be audited, this and that, and why would I want to do that? And I don't want people to think that they can do exactly what I do. I've been doing it for 37 years, folks. Some of you will be better at it than me. I concede that. An awful lot of you won't be better than me at what I do. I might make hundreds of % returns, which I do, every year. And I've done it for 37 years. But I also have losses. And as I told the gentleman out there, let's say that I have an average of 15 positions on at a time. And I'm managing those positions. And they're almost all options. And the options that I bought for $1, if they fall to 50 cents, I'm out. So if I lose 50% of my option, not stock, option position, I'm out. If the option doubles, which is the second point to take profits at a predetermined level, if the option doubles, goes from that same $1 to $2, I'll take off half. And then I'll let it run. If it starts falling back too quickly, I'll take the rest off and say I should have sold it all when it doubled. But that discipline will make sure that if I'm picking stocks decently, I'll end up with, 100 150, 200% returns across the board in my portfolio because I'm disciplined about taking those losses. That is the toughest thing. So we've got a fairly mixed crowd, not only very young, but we've got some mature veterans of the markets and so forth here as well. And we've got men and women here. I would say women have a much better ego about taking losses than men. I don't know why. Maybe it's something about our DNA, but it's really hard for men to admit we were wrong. That's why we hear all the jokes about, well, we won't stop and ask directions and things like that. Men. But a woman will say, how do I get from here to here? And now we don't have to anymore because we all have ways, so it doesn't matter. But back in the day, guys, that used to be a real thing. What I do is I cut losses, I take profits, and I always reassess based on any new information. So in other words, I'm going to give you guys a couple examples quickly here because we're nearing the end of my time. But when I say reassess, that is, if all of a sudden Apple came out and they blew out the upside on earnings or horribly missed to the downside, I would reassess regardless of whether the option had already doubled or whether I'd cut my losses already or not, because that's important to reassess that information. Here's examples of 2 trades from this week. So, for instance, here's EA. So just the day before they reported earnings, this is Electronic Arts, of course, somebody came in and they bought February 89 puts. The stock is almost $91 a share. They bought those puts for between $2.70 and $2.83. And they did other stuff, as you can see here. So to us, again, what did they do? They came in ahead of earnings and they bought puts. A put is a downside bet or protection against what you already own, one or the other. So if you're buying puts, you're bearish or you're scared. Or you're smart and you're trying to protect the gains you've already had in the stock, whatever. Any of those 3. So what did the stock do? They came out and EA blew out the earnings, but then said, our guidance going forward is horrific. We're going to earn half as much because Fortnite is killing us. So what did the stock do? Stock fell from 91 bucks all the way down to 78 bucks. Those puts that the guy bought for basically $2 went to $12. 600% return overnight. And you couldn't screw it up. If you bought those puts, you could not screw it up because it opened down the next day $12. And now, today it's making a $2 rebound back up to $82.42. So that's an example of following the smart money. Why did they buy those puts? I don't know. They have more eyes on what's going on and more feelers out there. Whatever the reason was, I doubt it was an insider buying those puts. If it is, they're probably going to jail. But whoever bought those puts was exactly right about what was going to happen in take 2. Separate one, Snap. Take a look at this one because this is so crazy. In Snap, many of us hate Snap. I hate it because they don't even come close to making any money. I have no idea other than, the obvious reasons that the thing was created to send basically naked pictures of yourself that disappear to somebody else. You guys never heard about that, I'm sure. But Snap, here was in the first week of the new year, second trading day of the new year, somebody came in and bought 12,500 February 7 calls. So the stock was $5.69 and they're buying the 7 calls. It's a big bet. That's 1.25 million share equivalent because, again, every one of these options is for 100 shares. So 12,500 is 1.25 million shares of Snap that they would control from $7 on. Then they came in also in middle of January and bought more, and they bought at the July strike. Well, what happened in Snap? Snap gapped up, biggest move it's made in its career. It went from basically $6 and whatever cents to, I believe, $9 on Wednesday this past week, just 2 days ago, or 1 day ago. So they told us, I want to own an awful lot of this stock from $7 on up. So they turned that option, which again was How much at the time? 25 cents they spent for that option. It went to $2. They made 10 times their money. Call it 9 even. 900% return on that particular trade on 1.2 million shares of stock. That's a nice return. So in other words, they put 25 cents in. Again, every option's 100 shares. So that's $25. And that $25 turned into $200. That's why I follow the smart money. That's why it's so fun to do what I do. Can I answer, Jordan, do I have time to answer any question or no? Yeah, let's do you guys have a question or two before they give me the hook? Sir? Do I like Robinhood? I do. I don't hate Robinhood. I mentioned it at the top of the show. As most of you know, you can trade for free on Robinhood. But they sell their order flow to people like me that want to trade against dumb money. So if somebody's always calling you dumb money, which means that you have to pay the offer or sell the bid, that's why Vinny Viola at Virtu owns the Florida Panthers, because he made a couple $2 billion and has the biggest house in New York City because of it. Right on Central Park, by the way. So is it wrong that they sell their order flow? No. Everybody does. Virtually everybody does. So if I said, well, you're dumb to trade at Robinhood, that means you're dumb to trade at TD Ameritrade. It means you're dumb to trade at E-Trade. It means you're dumb to trade at Schwab, because they all sell their order flow. Who do they sell it to? Vinny Viola at Virtu. They sell it to Citadel, the firm that I sold my floor trading operations and so forth. And why would they buy it? One of the guys that figured this out first was Bernie Madoff, believe it or not. It was probably one of those, other than, well, no, I won't even go there. But Bernie, because I had a lot of conversations with Bernie before we found out he was a crook. I was trying to buy something from him, but he wouldn't sell it. Bernie figured out that the market in Cisco was 30 bid, offered at 30.5. And the NASDAQ had colluded to keep the spread that wide. When I say colluded in air quotes, they were accused by the SEC of that. They ended up paying a multi-billion-dollar settlement when they agreed that they did collude to keep the quotes that wide. So in Microsoft, in Cisco, in any NASDAQ stock, they had agreed to keep the spread 50 cents wide. So you could bid $30.25 and they wouldn't show it. You would be shown on the $30 bid or at the $30.50 offer, but nothing in between. Meanwhile, the NASDAQ, the Instinet started a system that started trading in between the markets, but it was private and nobody saw it unless you had an Instinet terminal. So those people and Bernie figured out that if I could buy your option or your stock that you're trying to sell me at 30, and there's a bid at 30.25 on Instinet, I could take it from you, pay you 2 cents for the privilege, and make 50 cents selling it at $25 cents for selling it right here in the middle between the bid and the offer. And so they did that. Bernie did it, but unfortunately he told people about it. And then people much smarter than Bernie automated that in a heartbeat. And then they started doing it faster and faster and faster until it became high frequency, which it is today. So in other words, the part about buying order flow, they buy it because they think all of us collectively, not just the gentleman in the front row, but all of us are slower and dumber than their computers are. And so they will sell to you all day on the offer and buy from you all day on the bid, but it's not just Robinhood. So I think Robinhood's fine. Any other question? Sir?
What I don't understand about options, with margin, if I'm borrowing money, I'm responsible for that money.
Mm-hmm.
If I'm leveraging on options, how am I not responsible for that full 100 shares if things go downhill? What is my risk of loss if my bet is bad?
Sure. Gentleman's question is, what's my risk, and is it on the full 100 shares that he has the right to buy if he has bought that option? When you buy the option, you pay for it 100% up front. So when you're buying that option for 25 cents in the one on the screen, you've paid $25 per option. If you bought 10 of them, you paid $250. So your account still is whatever it was, but it will show that you spent $250 to buy those options. if they go out worthless, you lost 250 bucks. But you are never under the obligation as the owner of the option to exercise it. You don't have to exercise it. Meaning that if the stock would have gone the opposite way and fallen to 5 instead of run to 9, he doesn't have to exercise his right to buy it at 7. You're not under that obligation. You have a right, but not an obligation when you own an option. Sir?
What are some tips you have for beginning traders or people who want to get
Tips for beginning traders. A lot of them are in our book. So again, it's free, so I'm not selling you something. I'd say watch the market, pick some sectors that you're interested in, and then try to figure out how they make money, how that stock makes money. It's easy with Boeing. You know, you could say, oh, well, you know, they just go into the Paris Air Show and they just announced, you know, so many $1 billion in new sales and so forth. It's tougher with something like Snap because they don't make any money. They don't even come close to making any money. So that's all just a bet on the future, and those are much tougher to value. But finding some that you want to, that you're interested in, and I'd follow those. Sir?
Yes, call-put ratios. When you look at them on a daily basis, you can see there might be 1,000% more calls and puts, but they don't give you time frame. They don't know whether they're going to 7 days or 7 months. How do you find the time frame?
I don't know how you would find the time frame for that. We have systems that are looking at that as well. And the other part that I didn't really get to cover too much today, that'll have to be next year at Options MoneyShow University, is that it matters if they paid the offer or sold the bid. A lot of people can tell you and can look at the volume numbers on the screen and say, oh, it traded 15,000 options today, 15,000 calls, must be bullish. Nope. Were they sold on the bid? Did somebody do a buy right? In other words, did they buy the stock? Because our computer will always match up any large block buys in the stock against options and say, well, those were sold on the bid, and here's a corresponding purchase of the stock. That's covered right, which has, you know, marginal bullish upside and tremendous bearish potential if the thing goes south. But we care a lot about where did the option trade. On the offer is where I want them. If they didn't trade on the offer, I dismiss them because I don't care. If somebody sells a bunch of puts, I don't care. If they sell a bunch of calls, I don't care. If they buy puts, like they did in EA, I care. If they buy calls, like they did in Snap, I care. But I don't care about anything on the bid. So I don't look at ratios for that reason because, again, they don't break out on the offer or the bid. Only our algos do. You guys, thank you very much. I appreciate it.
Thank you, my friend.